In 48 hours, one man lost more money than most countries make in a year. $20 billion gone, and nobody saw it coming because nobody even knew he had it. Bill H. Hwang wasn't a household name. He didn't run a famous hedge fund. He didn't appear on Bloomberg or ring opening bells at the NYSE. He ran something called a family office, a private investment vehicle so obscure it barely had to report anything to the SEC. Inside that obscurity, he had quietly become one of the most powerful traders on earth. And in March 2021, the new world order he built collapsed so fast it took 5 major banks down with him. This isn't just the story of one man's greed. It's the story of a loophole so large you could fit $100 billion through it, and how regulators let it happen in plain sight. Viacom CBS shareholders watched their stock drop 27% in a single day without understanding why. Employees at Credit Suisse watched their careers evaporate when the bank posted a $5 billion loss from a single client nobody had ever heard of. Nomura lost $2.9 billion, Morgan Stanley nearly $1 billion more. One client, one collapse. The system was supposed to prevent this. It didn't, and the instruments H. Hwang used to build his empire are still legal, still in use, and still largely invisible to the public. If you have any money in the market, this story is directly relevant to you. To understand Archegos, you have to understand Bill H. Hwang. H. Hwang came up as a protege of Julian Robertson at Tiger Management, one of the most prestigious hedge funds of the 1990s. He was sharp, disciplined, and deeply religious, known for running Bible study sessions with his analysts. When Robertson wound Tiger down in 2000, H. Hwang took seed money from his mentor and launched Tiger Asia Management. Focused on Hong Kong and Chinese equities, Tiger Asia grew to $10 billion under management. H. Hwang had a genuine gift for identifying undervalued Asian companies before Western analysts caught on. His track record was exceptional. His reputation was golden. Then it wasn't. In 2012, Tiger Asia pleaded guilty to wire fraud. H. Hwang personally settled with the SEC for $44 million, admitting to trading on inside information obtained from investment banks pitching him stock deals. Hong Kong regulators banned him from trading there for 4 years. In any normal industry, that ends your career. But here's what happened instead. H. Hwang converted Tiger Asia into a family office, Archegos Capital Management. Family offices manage money for a single ultra-wealthy family. The key legal distinction: they don't manage outside client money. So they don't have to register as investment advisors or file the same disclosures as a hedge fund. In H. Hwang's case, this meant one thing: invisibility. And with invisibility came a new strategy. Instead of buying stocks directly, which would require SEC disclosure when positions crossed certain thresholds, H. Hwang used instruments called total return swaps. Here's how they work. H. Hwang would approach the prime brokerage desk at a major bank, Goldman Sachs, Credit Suisse, Morgan Stanley, and effectively say, "Buy me $1 billion of Viacom CBS and hold it on your books. I'll pay you fees and collect all the price gains." The bank held the actual stock. H. Hwang held the economic exposure. Because he owned the swap and not the shares, he had no disclosure obligation. He ran this arrangement simultaneously with 5, 6, 7 different banks. Each bank thought they were his primary prime broker. None of them knew about the others. By early 2021, H. Hwang had accumulated roughly $100 billion in notional exposure on approximately $10 to $15 billion in actual capital. That's leverage of nearly 10 to 1, concentrated in a small cluster of bets. Viacom CBS, Discovery, GSX, Tekadu, Baidu, Tencent Music, Farfetch. The market didn't know. The SEC didn't know. And the banks enabling it, to a remarkable degree, didn't know about each other. Here's what they all missed. When you run 10 to 1 leverage on a concentrated portfolio, you are one bad week from total wipeout. The math is unforgiving. A 10% drop in your positions eliminates your entire equity cushion. H. Hwang's holdings weren't diversified. They were correlated. They were illiquid relative to their scale. And they were enormous compared to the actual trading volume of the underlying stocks. In some cases, H. Hwang's swap positions accounted for a double-digit percentage of the entire float. In March 2021, Viacom CBS announced a secondary offering, selling new shares to raise capital, standard corporate finance. But new share issuance dilutes existing shareholders, and the price typically drops. Viacom CBS stock, which had tripled in the preceding months largely because H. Hwang's swap network was soaking up supply, began to slide. Margin calls triggered. A margin call means the bank demands more collateral. If you can't post it, they liquidate your position to cover themselves. Hwang couldn't meet the calls. What followed was one of the fastest wealth destructions in recorded financial history. Goldman Sachs and Morgan Stanley moved first. They began quietly selling Archegos' positions in pre-market block trades on Friday, March 26th. Blocks of 10 million, 20 million shares hitting the market before the broader street understood what was happening. By the time competing prime brokers figured it out, Goldman and Morgan had already cut most of their exposure. They took manageable losses. Credit Suisse and Nomura were not so quick. By Friday afternoon, Viacom CBS had dropped 27% in a single session. Discovery fell 27%. GSX fell 53%. Billions in paper value evaporated as banks tried to sell into a panicking market with no natural buyers. Credit Suisse, reportedly hampered by internal risk failures and a culture that treated Hwang as too lucrative a client to challenge aggressively, eventually booked $5 billion in losses, the largest single client loss in the bank's 165-year history. Nomura announced a $2.9 billion hit. The total bill, counting every bank's losses, Archegos' equity, and the collateral damage to shareholders of the stocks involved, approached $20 billion. In 48 hours, a man who had already been caught cheating once, banned from an entire country's markets, had used a legal loophole to do it again at 100 times the scale. But it gets worse. Federal prosecutors didn't buy the legal loophole framing. In April 2022, the Department of Justice arrested Hwang on charges of racketeering, securities fraud, and wire fraud. Prosecutors alleged the entire operation was a coordinated manipulation scheme, that Hwang and his team deliberately used the swap network to inflate the prices of the stocks they held, manufacturing the appearance of momentum that kept prime brokers from scrutinizing their exposure. His CFO was arrested the same day. In November 2024, Bill Hwang was sentenced to 18 years in federal prison. Credit Suisse never recovered. The Archegos losses, compounded by other scandals, contributed to a collapse of confidence that ended with a forced merger into UBS in March 2023, the end of a 167-year institution. One client, one hidden position, one systemic failure that regulators watched build in slow motion. So what can we actually take away from Archegos? The first lesson is about leverage. Hwang's genius and his fatal flaw were the same thing. He was convinced he could see value others missed, and he was probably right. But 10-to-1 leverage doesn't care how smart you are. One bad catalyst, one margin call, and the structure unwinds faster than you can respond. The higher the leverage, the smaller the margin for error. This applies whether you're running a billion-dollar family office or trading options on a retail account. Size without resilience is not a position, it is a countdown. The second lesson is about concentration. Hwang's $100 billion in notional exposure was spread across roughly a dozen names. When one moved against him, the others followed. Diversification isn't a cliché, it is the only real protection against the unpredictable. The moment your portfolio's outcome depends on a single stock, sector, or thesis, you have stopped investing and started betting. The third lesson is about opacity, specifically who benefits from it. The banks that lost billions weren't naive. They were willfully incurious, because Hwang was generating enormous fee income. If someone managing your money can't explain clearly what they own and why, that's not complexity, that's a red flag. Complexity that serves the manager at the expense of your visibility is almost never in your interest. The people inside Archegos didn't set out to destroy Credit Suisse or crater their prime brokers. Most of them believed they were winning. Bill Hwang genuinely believed he was a gifted steward of capital. The difference between their story and yours isn't intelligence. It's the discipline to stay inside your risk limits even when the bets are working. Especially when the bets are working. If today's story made you think harder about how your own money is structured, what you actually own, how leveraged it is, how concentrated, Webull lets you trade commission-free for 90 days and see your full portfolio exposure in one dashboard. It won't protect you from every mistake, but being able to see your positions clearly is exactly the kind of awareness this story is about. Check it out at Webull.com. And if you want more deep dives like this one, the mechanics behind the biggest financial collapses in history, told straight hit subscribe and save this video so you can come back to it. One question before you go, was Archegos fraud from day one, or did it start as aggressive but legal finance and slowly cross the line? Tell me below.